Ladies and gentlemen, good day and welcome to Galaxy Surfactants Limited Q3 9th month FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involves risk and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. We have with us Mr. Unnatan Shekhar, Promoter, Managing Director, Mr. Natarajan K. Krishnan, Executive Director and Chief Operating Officer, Mr. Abhijit Damle, Chief Financial Officer from Galaxy Surfactants Limited. I now hand the conference over to Mr. Unnatan Shekhar. Thank you and over to you, sir.
Thank you. A very good afternoon, ladies and gentlemen. It gives me immense pleasure to welcome you all once again for our Q3 FY23 conference call. Before we get into details, it is important for all of us to understand the journey, the story that has played out over the last 18 months. It was exactly a year back when we had reported one of our weakest quarters. This had come on the back of another weak quarter which saw your company report its first volume decline. Questions were being asked on the inherent strength of our business model, and though we remained confident, we knew only our actions and performance could reimpose and reassure our investors. As American author Robert Collier once said, success is a sum of small efforts repeated day in and day out. And at Galaxy, we have practiced and demonstrated the same over decades now. Between the small and consistent efforts put in by our team day in and day out, that has ensured that we report our best quarter till date in terms of operational profitability and record the best calendar year in Galaxy's history. Truly a remarkable turnaround when compared to our performance 12 months ago, given the highly volatile macro backdrop. It is important that to understand the context here because on one side we had an inflationary as well as a deflationary backdrop, and on the other we had significant demand cutbacks and deteriorating economies. But despite the multifold challenges, we have consistently grown and achieved our FY22 profit in the first months of FY23. The consistency demonstrated by the team is worthy of praise, and I take this opportunity to acknowledge and thank them for the same. While numbers are lag indicators, one of the lead indicators is the equation we share with our customers. It gives me immense pleasure to share with you all that we recently received the Clean Future Partner Award from Unilever. This award was only given to 6 suppliers globally who have partnered with Unilever and through multiple innovations enabled them in their journey towards a cleaner future. As it is said, success is a journey and not a destination, and for us, the journey of innovation, partnering with purpose with all our stakeholders and delivering consistent performance continues. The inherent business model remains robust, and with a strong talent pipeline, we remain positive, confident, and optimistic of a brighter future. Moving on to the business performance, it is important that we understand the structural drivers as well as the short-term factors influencing it. India continues to remain a bright spot for us. While the volumes have grown 12% in Q3 and 7.7% for the 9 months till December, the bigger picture is what pleases us. Today, we are on course to cross the 100,000 metric ton sales number for India. The same stood at 69 to 61 metric tons in FY18, thus growing at 8% CAGR over the past 5 years. Based on this performance, we can safely conclude that the structural uptick we witnessed during COVID has not only sustained, but as inflationary pressures ease, we can expect further build-up in momentum. I would urge you all to look at the bigger picture, which remains bright and healthy. The Africa, Middle East Turkey region has been a point of concern. While volumes have declined 14.8% till December and 6% for the quarter, it is the macroeconomic volatility that is a point of concern. This year has seen the Egyptian pound depreciate by 100% compared to December 21 and the Turkish lira by 71%. While the lira seems to have stabilized, the Egyptian pound in the last 1 month has further depreciated by 25%. As our performance in India shows, a stable macroeconomic environment is a precursor to growth. Stability ensures growth, and it is this stability that has ensured that on one hand we have India crossing the 100,000 metric ton mark annually, and on the other, AMET recording its lowest volumes since FY17. On an aggregate level, as well as for the past 3 years, our volumes have remained flat, mainly due to the slowdown in AMET. Nearly 10% of the volume decline on an aggregate level has been contributed by the AMET markets, which has in turn been recouped by the growing India market, thus ensuring we remain flat on an aggregate level. But like it is said, there is always light at the end of the tunnel. This quarter has seen AMET grow 11% sequentially, with the bulk of the growth coming from the local Egypt market. While it would be prudent to observe for one more quarter, barring for any other currency depreciation, we do remain hopeful that the worst is behind us. Volume momentum in AMET should make a comeback, and we remain optimistic about FY24. The rest of the world has been a mixed bag for us. The last 4 years have seen multifold challenges of varying magnitude. While in FY20 and 21, our volumes got impacted due to the pandemic, FY22 supply chain issues further compounded the situation. As supply side factors started improving, the contraction of demand in Europe and China this year adversely impacted our performance. While the challenges continue, we do see our performance improving significantly in FY24. The optimism is based on consumption making a strong comeback in Europe and developed markets, warding off a recession. This in turn will aid our specialties, which declined 9% in this quarter, and 5.6% YTD. Before we move on to the outlook, it is important to understand the nuances of our operation performance, which has been the best till date in this quarter. While multiple initiatives are being carried out in terms of product mix, operational improvements, or judicious price calls to capitalize on emerging opportunities, we need to acknowledge that the decline in volumes as well as reversal of multiple supply-led factors have also contributed towards this performance. While some of these efficiencies will continue in the coming year, but for ensuring sustainable growth, volumes will be the key. While inflationary pressures have impacted the mass and the masstige segments, thus impacting our performance products, easing inflationary pressure will ensure volume growth, which will eventually result in correction of our EBITDA per metric ton as and when the same happens. This will particularly be true as the Africa, Middle East, Turkey volumes recover. The recovery in Europe and China will aid our specialty volumes, thus ensuring volume growth for each of the segments. While the magnitude of recovery and period within which the same happens remains to be seen, we remain confident of complying with our cardinal principles that govern our business growth, which are volume growth of 6 to 8%, EBITDA growth being higher than volume growth, and PAT growth being higher than EBITDA growth, with return on capital employed in the 22% zone. The structural framework that has enabled our growth over decades remains the same, and the volumes are an integral part of it. Therefore, while we specifically would refrain from giving out an EBITDA per metric tons guidance for FY24, it is safe to assume that your company will aspire to grow in terms of volumes as well as EBITDA for the coming year. To conclude, ladies and gentlemen, it is said that success in business is all about building relationships, talent pipelines, great products, and robust processes consistently and passionately. At Galaxy, we have done that for the past 4 decades, and the ensuing decades will be no different. Thank you, ladies and gentlemen.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Yep. Should I go ahead with the questions?
Yeah, please.
All right. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Good morning. Good afternoon, sir. Thank you. Thanks for taking my question. I got a couple of them. One on your cardinal rule of 6 to 8% volume growth, followed by higher EBITDA and then even better PAT growth. Now, considering that we are at an EBITDA per kg of close to 26-27 rupees, and a volume growth of 6-8%. So if we want to comply with this growth where EBITDA normalizes, the volume growth requires to be significantly higher and the contraction requires to be significantly lower. How should one see this in a very near term? I can agree with you on a longer term that this may be established and we have done it for last 20 odd years. But for say next 1 to 2 years, how should we see this framework working for us? That's my first question.
Sanjesh, in any case, as far as the last 9 months is concerned, we need to understand that some of this EBITDA per metric ton contribution has come from certain export benefits incentives which we received, which were accumulated for a previous period in Egypt. It was quite significant as far as the last year, these 9 months were concerned, because they were of the order of approximately maybe 20 crores or so. Okay, so that has been a very important inflow. We have also had certain sourcing gains which came particularly because of a steep reversal in terms of raw materials during this particular period. And furthermore, as far as the freight rates, which were very adverse in the same time last year, those with improvement in supply chain, those particular we had a reversal of those reversals. Okay, so these are the sort of significant contributors as far as EBITDA per metric ton is concerned, as far as this quarter is concerned. So over a period of time, what we have done in terms of improvement EBITDA is, of course, focused on certain significant mix as far as our entire product portfolio is concerned, and again, chosen customers very, very carefully in the regions, in the various regions that we operate. Now, we remain optimistic about. We want to remain optimistic about our volume growth, despite the various inflationary and deflationary situations that we are experiencing in various parts of the world. We would like to remain optimistic as far as our volume growth is concerned. And yes, for us, that particular cardinal principle of EBITDA growth being higher than volume growth is a guiding principle which we would like to not only adhere to, follow, but even surpass that. Now that's it, Sanjesh.
Fair enough. So this 20 crore benefit in Egypt is for this quarter or is for the 9 months FY23?
It was for a previous period. Because as we know, we don't book any export benefit volume till it is realized. Okay, that is a policy that we have followed, which we have communicated many times before.
No, sir, that is fairly understood. This 20 crore is being booked for this quarter per se or for the 9 months?
Basically, we book it on a cash basis.
And it was booked in this quarter. It was booked in this quarter.
And what is the same number for the 9 months?
I think more or less everything came only this quarter only. Am I right?
Okay. Got it. My second question is volume growth. I do appreciate that you have a 6 to 8% volume growth, but considering a sequential 11% growth in the MAT region and from next quarter onwards we will be on a much favorable base, Do you think next year could be an exceptional year where we are normalizing for the last 2 to 3 years decline in the MAT? That's number one. Number two, can Turkey become an incremental challenge for us given the situation in Turkey remains very fragile? How do you see the MAT in a lens where Turkey is there? And number three, are we doing anything for a longer term protection of this volatility in MAT, or we have to live with it considering that's how those markets behave? These are my three questions on the volume.
Yeah, Sanjesh. Natarajan, yeah. Good morning.
Hi, sir. Good morning.
So, see, with regard to Ahmed, if you see in terms of local Egypt volumes, we are seeing things are getting better. So we need to wait for one more quarter to know that it sustains. But that is really a good this thing. Despite the steep 100% inflation, we are able to see things getting better. Now, Turkey, unfortunately, Turkey was also adjusting to the inflation almost 70%, but this earthquake has thrown things off guard. But yes, as of now, our only this thing is to see that our customers and their families are safe. We probably have a better idea probably in the next 15 days as to whether we see any impact, because more than the demand, I think it's how do you reach the supply, so we are assessing that. So it would be too early for us to make a comment on that. With regard to the entire Ahmed volumes, Egypt, as I said, is getting better. Okay, and only thing is that what I can surmise is that with inflationary pressures coming down, both in terms of commodity and food price, and we also see with the winter going up, the energy inflation also is going to be much better. So it only augurs well, okay, for the volume growth to happen pretty well. So I think this I can conclude safely that the worst is behind us as far as Ahmed volumes are concerned.
No, that's fair enough, Natarajan. But just thinking, can FY24 be a year where we normalize all the last 2 years of decline, where we can recoup and market is also coming back? What are our customers telling in terms of their market share? Because I think they have lost a significant market share in the local market.
Yeah, correct. So customers are also, they're probably also saying that things augur well for them in terms of the prices getting now corrected. They do hope, they do expect that things should start getting better. So what I'm saying is a reflection of what my customers share with me.
Got it. Thank you. My last question is on the competition. One on a general competition within India, where we have seen few surfactant companies like Aarti have been coming back, and number two on the phenoxyethanol, I think Rosari is talking of expanding their footprint in the export market. How do we see competitive intensity coming out of India base?
So we have been, Sanjay, as you know, that in the last 40 decades, we have seen and managed a huge amount of competition. So this is nothing new. I don't see this as anything of great significance. So we know how to compete, and that's important. And I hope that the market allows everyone to grow, but certainly we know how to manage competition.
So we remain confident of maintaining and improving our market share, right?
Yes, of course.
Okay, got it. Thank you very much, and best of luck for the coming quarters.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Rohan Gupta from Nuvama. Please go ahead.
Yeah, hi sir. Good afternoon. Thanks for the opportunity. Once again, congratulations on such a strong set of numbers. So the question may be a little bit extension of the previous answer which you gave the previous participant. Shekhar sir, if I heard you rightly, that you said that definitely EBITDA margins per ton this year, 9 months have been phenomenally high, benefiting from the multiple factors and product mix and also the exports benefit. But I think that you are still, though you didn't give any guidance on margins per ton, but if I heard you rightly, you said that we are still looking at absolute EBITDA growth next year. Am I right, sir, on that front?
No, the EBITDA per ton certainly, as our cardinal principle says, we would be ahead of the volume growth. That is what our strive will be. Okay.
So, if I extrapolate that, it means that we are still looking EBITDA margins per ton next year will be much above than what you used to give earlier guidance of 16 to 18,000 rupees per ton. If we are still looking.
What I would like you to note is that this particular EBITDA per ton is in terms of a certain proportion of performance and specialty. Okay? So when the performance and specialty percentages normalize, okay, then we would again see, but in the individual categories, our striving will be to grow the EBITDA per ton at a higher rate with vis-a-vis the volume growth rate. Okay, but the overall growth rate is a mix of both specialty contributions as well as performance contributions.
So fair enough. Come whatever permutation combinations we apply, I mean, in terms of the change in the product mix, we understand that this 9 months have been tepid in terms of volume growth for specialty. And going forward, probably that the surfactant business will drive the volume growth. That we fairly understand. But still, sir, volume growth in surfactant business, and given the sticky nature of our business, it cannot be 30-40% in terms of the volume growth. So the volume growth has to be in a certain percentage range of maybe just 8% to 12% kind of growth in absolute volume. Also, we will see the price-led decline in terms of the because of the softening raw material prices. So probably a revenue growth which we may be looking probably for FY24 maybe as modest as maybe a flat. With that top line growth, what I am just concerned that if we are not able to protect our EBITDA margins per ton and with a certain weakness, probably we should be seeing a declining EBITDA. Absolute EBITDA should be declining in FY24. That's what our numbers suggest. So, but on the contrary, you still look at growing EBITDA. So that's something which not able to comprehend.
Rohan, I'll answer this. Natarajan here. So I don't know that how we have worked it out, but I can tell you in a simple way how do we look at business. First is it is clear that the only way to sustainably grow your business is to ensure that you grow your volumes ahead of the market. That's very clear. In situations, and if you see, till the time that the volume, global macroeconomic headwinds resulted in a negative growth in volumes, we were actually growing our volumes pretty significantly ahead of the market, and even this year we are, okay. But whenever we see that the volume growth is not going to become an opportunity, in the volume growth is not going to be available, in fact it's going to degrow, we need to then smartly manage our operations, okay, our product mix and our pricing. And which what you do, because ultimate aim is to deliver profitable growth. Now when my volumes degrow, how do I deliver a better EBITDA growth is what we look at. Now when we do see that there are good signs for us to start growing our volumes, then we need to ensure, okay, that we need to prioritize our entire strategy in terms of getting the volumes back and participate fully in the volume growth. So this will result, because finally EBITDA per metric is only a resultant of that. But we are very clear that we will continue to grow our EBITDA, year-on-year EBITDA as well as, but what the volume growth is only something what the market will allow us. But we would want to ensure that grow our EBITDA year-on-year, okay, to ensure that we deliver on a profitable growth.
Fine enough, sir. So it should also be implied that whenever the market picks up significantly and there is an opportunity to gain market share in terms of volume growth, you may offer some price discounts to the customers to gain even slightly higher volume growth. Will that be the scenario?
Yeah, that depends on the case to case, and obviously yes, that typically is what we'll do, because if the volumes are going to come back, that's what even the customers will do, correct, Rohan? They will start reducing price only when they say that it's going to result in volume growth. When they do that, and typically any businessman will operate, and that's what we will also do.
Right, sir. So just second question is on our, we have always mentioned that our ROC profile generally we look at is 22% plus before looking any projects. But historically we have seen in last 3 to 4 years our margin profile have improved significantly in terms of absolute EBITDA per ton. That used to be roughly 13,000 and now we are almost at 18 to 20,000 on a generalized basis or normalized basis. Right now, so definitely it's there. I don't see that there would have been any significant increase in asset turn or capex costs have gone up so significantly, except that maybe some marginal increase. Should we assume that the ROC profile of the company in last 4 to 5 years have also improved, and now the project which we undertake is on about 22% on maybe what it was earlier, but now it is roughly 26 to 27% if you look at the current margin profile?
ROC will continue to be at the threshold will continue to be at 22%.
Yeah, so Rohan, it's like this. We are very clear in the way that we direction the efforts to deliver weighted average ROC of 22%, but how we look at individual projects are very different. Okay, so this thing is to deliver 22%. That's how we work on. Now, depending on how depending on project-wise, product-wise, the thresholds are very different. But we'll be delivering. So typically, you can have times when the ROC can be a little bit somebody lower, but it will always be with the very clear listing of delivering a weighted average cost of return capital employed of 22%.
The third question, if I am allowed, and if there is a long queue, I can come back in queue again. So, in terms of volume growth guidance, I know it's a volatile market scenario and the recession fear in a global market, but still you see that with the falling raw material prices, I mean inflation is easing now. What kind of volume growth or just simple market share or market growth you can anticipate over next couple of years? Can it be significantly higher than last 4 to 5 years average, which we used to guide 6 to 8%? Can it be in a 15 to 18% volume growth range over next couple of years?
No, we would be happy if that happens. Certainly, we look forward to that happening. But yes, I don't think that we would be able to hazard any guess on what the volume growth will be with the inflationary correction happening. We are very clear that this thing is deliver 6 to 8% in line with the way the market grows. Now, if the market grows by 10%, we need to grow ahead of that. If the market grows only by 4%, we'll have to grow ahead of that. That's the way it is. Now, how the current price reductions will start resulting in volume, we need to wait and watch, Rohan. I'll not be able to hazard any guess on that.
Thanks a lot, sir. Thank you very much for answering all the questions.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Rohit Nagaraj from Centrum Broking. Please go ahead.
Yeah, good afternoon, sir, and thanks for the opportunity. And again, congrats on good set of numbers. So first question is, last time we had alluded that the inventories at customer end were higher. What is the scenario that we are experiencing now across our operating geographies? Thank you.
Yeah, so we do see that I think the inventory reductions in many of the markets other than US typically I think there is still some amount of correction that is expected. That's what our customers tell us. Okay. Otherwise, I think in most of the other geographies, I think there is no inventory corrections to be done furthermore. It's only in the US, as I said, we expect some more to happen because the pipeline inventory is still not got corrected.
आपण ज्या व्यक्तीशी बोलत आहात.
Hello.
Hello. Yeah. Am I audible?
Yeah. So did you hear my response, Rohit?
Sorry, I got there was some disturbance.
What I said was, except for US, where we are informed by customers that there is still some amount of inventory corrections to be done, okay, in the trade, whereas in all the other geographies they say things have got the inventory corrections have been done.
Sure. That's helpful. So second question is again, apologies for hopping on again on the EBITDA per metric ton, figure. So you alluded that there was a 20 crore one-time impact from the Egypt. Now, couple of questions to this. Is this recurring in future as well? That is one part. And second part, in first 9 months, what was any other one-time benefit that we have received beyond this 20 crore, because of which the number which is close to about 25,000 EBITDA per metric ton for 9 months is probably inflated. Thank you.
So other than this export incentive that we received, there has been no other significant one-time
9 months में कितना
in
है? Quarter was 20, but in 9 months, how much was it?
9 months, it would be somewhere around, I think, 23-24 crores.
Okay. Yeah. So I think you heard it?
Yes, 23-24 crore of the 9 months.
Yes.
Right. And will this be occurring in future as well, right? And whenever we book the volumes.
That's why that's the reason, because there's uncertainty, we account it on cash basis, because it's only when the government releases the money that we can. When they will release is anybody's guess. Okay, so that's right. So we cannot make any statement on what will be next quarter or 6 months, next 6 months.
Sure. That's very clear. Thank you so much. I'll come back in the queue.
Thank you. Next question comes from the line of Dhruv Muchal from HDFC Mutual Fund. Please go ahead.
Yes, sir. Thank you so much. So the question is again coming back to the EBITDA per ton or per kg. You mentioned part of the reason is because of the product mix. Some of the products are depending upon the product mix. But if I look at the gap between the growth in the performance products and the specialty products, the share of performance products has increased in the last say this quarter or the last 9 months. So, based on your, is it fair to then conclude that the EBITDA per kg that you earn on the performance product is probably higher than the specialty products?
No.
See, what I can tell you is that even within performance products, okay, there are products and certain segments where we are able to manage better realizations depending on how the market allows us an opportunity. Okay, so it's always the case where the specialty is higher in terms of EBITDA per metric ton. Okay, but even within performance, there are times where we are able to get better pricing, and that's what we have been able to do over the last 9 to 12 months.
Okay, so because otherwise this does not give a clear picture, is because if the share of performance has increased and EBITDA per ton has increased, on an overall basis, it seems your EBITDA per ton on EBITDA per kg on the performance product is better. Based on what your commentary is, that it is the product mix which is partly driving this EBITDA per kg increase.
Product mix within performance, product mix even within specialty. Okay, so even within specialty, there are certain products where we have been able to get, they have been positioned well in terms of better realizations. So it's a combination of all this.
Okay. And okay. And is there also if I look at your MNC share has increased, your 51% it was last year YTD, it is now 56%. Some of the other regional and local levels have declined. Earlier we used to think the MNCs have a better marketing power, so probably the EBITDA per kg will be lower there. But that seems not to be the case.
No, I don't think you can draw any such correlation. Okay. But one thing is that it is important that what this probably should conclude from this is that the sort of strength of the relationships that we have, and obviously in this market situation, you would see that only the big players have been able to take out the inflation and are able to grow. So that actually is a demonstration of the sort of the business model that we have, the sound business model that we have.
Sure, sir. Got it. Thank you so much. Thanks. All the best.
Thank you. Next question comes from the line of Sri Krishna Santi from JM Financials. Please go ahead.
Good afternoon, sir.
Good afternoon. Please go ahead.
The line of Sri Krishna has been disconnected. We'll go for the next participant, and that is Mr. C.A. Garvit Goyal from Invest Research. Please go ahead.
Hello.
Yeah.
Good afternoon, sir. Am I audible?
Can you be a bit louder, please?
Yes. Yes, sure. Now, is it okay? Hello?
Yeah.
Okay, yes, sir. So, most of my questions have been answered. Just one thing, whether your 9-month EBITDA per metric ton is sustainable in FY24. You mentioned it is around 23 CR because of export incentive. So if we exclude that impact, then also it is around 23,700 per ton. So can we achieve this 23,700 number in FY24, sir?
No, that's what we said. This EBITDA per metric ton is only final result of what the way that we conduct our business. So that's what I explained. Now, whenever the first priority, business priority is to ensure that we grow our volumes ahead of the market. If the market doesn't allow you to grow your volumes because of the macroeconomic headwinds, then we need to see how we manage the profitability, because finally our objective is to deliver profitable growth. But delivering volume growth is priority. So if the market now starts offering me opportunity to enhance volumes after the, once the prices start correcting and the consumer demand starts coming back, we will then start prioritizing growing our volumes. And then the EBITDA per metric ton will be different. So how it will pan out, we're not able to say. That's precisely why we're not able to give you a guidance on EBITDA per metric ton. But what Shekhar said very clearly in his address is that we will grow our volumes ahead of the market, and we'll also grow our EBITDA ahead of our volume growth and our PAT ahead of the EBITDA growth. So that tells us as to how we are structuring the way that we do our business.
Okay, that's all from my side.
Thank you.
Thank you. The next question comes from the line of Bobby Jayaraman from Falcon. Please go ahead.
Yeah, hello. Compared to last quarter, your volumes barely grew. Then how did you achieve growth and realization? The overall revenues, how did they grow?
Can you repeat your question? I couldn't hear properly. Can you please repeat your question?
Yeah, the year-on-year volume growth for this quarter was flat. So how did you achieve your revenue growth given a falling RM environment?
See, the revenue growth is, it has a correspondence to the raw material prices.
Yeah, so raw material prices start correcting, but then we also need to know that it always corrects with a lag of 3 to 5 months. Okay, so there will still be some pricing that have been done based on the raw material price that was 3 to 5 months back. So you would not see an immediate correlation between raw material price coming down and the revenue growth getting impacted. So you will see that Jan, Feb, March revenue growth will be much lower than the previous quarter, this quarter, because the corrected price would start reflecting in Jan, Feb, March.
Okay, got it. But how would that impact your EBITDA?
Impact our?
Yeah, we did mention that we had certain sourcing gains because of the reversal of raw material prices. Okay, that also added to our EBITDA per metric ton.
So the next quarter, likely when the revenue normalizes, reflecting the lower RM environment, your EBITDA would come down too, correct? That's what you're saying.
Yeah, so what we are saying is that, if there are opportunities available in the market to manage your positions in a way that you're able to get better relations, that's what we will do. Now, as I said, in the next quarter, okay, more important is to prioritize our volume growth. So whether there are two things. One is in terms of whether we will be able to get the volume growth with giving price reductions, and whether my raw material scenario will allow me to be able to get certain efficiencies. Now, this is something that that we'll be able to say only after the quarter ends, because our day-to-day way of doing business to ensure that we are able to get a volume growth and manage our RM positions in a way that we are able to get better realization. So that's where I'd like to put it.
Okay, so looks like there are too many moving pieces here, right? Essentially.
Yeah, there are. You got it right. You got it right.
Okay, my next question is, I remember in some of the earlier Concalls you had mentioned that during the COVID days that you're seeing a lot of business from the e-commerce players, the new e-commerce players that have been they started selling consumer goods. Is that still on, or was that just a?
That trend continues. I think a number of e-commerce players have strengthened themselves, grown pretty well. There have also been cases where some e-commerce players have fallen by the wayside. Okay, so the good guys are getting better and better and growing.
Okay, so they would also be a driver for your volume growth, right? Which didn't exist before the COVID, correct?
Yeah, they do offer opportunities for volume growth, but as you know, the e-commerce segment is a very, very small portion of the overall, size of the market.
Okay. Got it. All right. Thank you very much.
Thank you.
Thank you. Next question comes from the line of Bhargava Buddhadev from Kotak Funds. Please go ahead.
Yeah, good afternoon, team, and congrats on a good performance. I have a couple of questions. One is, what would be the contribution of Turkey in terms of our overall revenue?
Turkey will be approximately 9 to 10% of our overall.
Okay. And that you mentioned, you'll come to know the exact assessment only in the next 15 to 20 days.
Yeah, because Bhargava, what's happening is that right now when we are assessing whether any of our shipments have got into trouble. So we have realized that that's not an issue there. And then the second is we are now only talking to all the customers. Now the impact on business is we'll probably wait. It's not the right time. So we'll assess that probably in the coming days. Okay? Yeah.
But do you think there is a significant risk to this business maybe in FY24 or too early to assess?
It's too early. I don't know. If you ask me, I'm not able to comment in terms of whether very clearly that this will not have any impact. But yes, the probability looks lower. We need to wait. There
will be some impact, but there will be some impact.
Yeah, short term. Because more in terms of the demand sentiment getting impacted there. So which we'll see. But we don't see it to be prolonged once they start adjusting to the new normal.
Yeah.
Sure. And my second question is, out of our 1,800 odd customers, how many of them would still be under ladder 1? And obviously, your endeavor would be to graduate them to ladder 2, ladder 3, etc., etc.
You're right. See, obviously, the topmost step in the ladders takes anywhere between 25 to 30 years. Okay, so this climbing is, gradual, deliberate, and compounded and cumulative. So a majority of our customers in this 1,800 will all be in the first step of the ladder. Okay, so as we have always mentioned, the number of customers in the topmost step of the ladder you can count on fingers.
Right.
Yeah.
All right.
Yeah.
So would it be fair to say that 80% would be ladder 1 or maybe more?
Even more.
Achha,
even more. Even more.
Okay.
Yeah.
Yeah, but it's important that we get them into ladder 1 and keep them there and then move them to the subsequent valves. So that's also an important job for us to do, which we are doing pretty well.
And as they move up the ladder, obviously the effort increases disproportionately in terms of engagement, right?
You're right. Obviously, also the opportunities increase manifold. Okay. Or the engagement increases, the opportunity also increases because you are able to deal with them a wider package of your products.
And would it be fair to say that we would have 100% share of them as they move up the ladder, or they go to some other supplier?
No. Normally we have seen that all customers, in their own risk matrix, don't like to have only one supplier in their procurement. They always have one more supplier to ensure that they fulfill their risk criteria as far as their organization is concerned.
Understood. Okay, sir. Thank you for your time and all the best.
Yeah.
Thank you so much.
Thank you. Next question comes from the line of Anubhav Shahu from IC Researcher. Please go ahead.
Yeah.
Yeah, Anubhav.
Yeah. Thanks a lot for the opportunity. Couple of questions. One is on your comment on the benefit arising out of sourcing gain from due to reversal in raw material prices. So when you mention that, do you mean to say that you could get some better deals in getting some of the input prices, which is otherwise in the normal course of operation we don't do? Is that the case?
No, see, it's a question
It's a combination of many things. Okay.
Yeah.
It also the way we manage our procurement, which we have said is an area which we are very, very particular about and thought. Given that the raw materials are highly, subject to ups and downs.
Right.
Yeah.
Okay. And is there a way you can quantify this benefit which happened this quarter, which otherwise is not a normal course of operation?
No, that we will not be able to comment upon.
Okay. Thanks. And so you did mention about the channel inventory, and I think the inventory at the customer at the US operation probably is on the higher side. I had a question regarding our position on our own inventory. I mean, it looks like as for the result for Q3 is concerned, we probably were not impacted much on high cost inventory. How do you see this thing? Are we past that challenge? Because there has been quite a good climb down of the fatty alcohol prices and all. So how are we positioned as far as the high cost inventory is concerned?
No, so we ensure that we are always flowing in line with the market. So it will start reflecting the buying prices will start reflecting in the lower prices as the months move on. But as I did answer a question earlier, that the prices will not start reflecting immediately. The alcohol prices start correcting, say 4 months back. It again went up. It again has come down. So it's a combination. So you'll see a directional trend in terms of my raw material inventory prices coming down very clearly.
Okay.
Yeah. Okay. You will see my price Jan, Feb, March will be lower than what it was October, November, December. Logically, because the corrections majorly started in June, July, came down again, went up. It's come down again. So we'll see that. Yeah.
Okay. Quite clear. Thanks a lot for this. Yeah.
Thank you. Next question comes from the line of Malay Samir from Breakthroughs in Stock Market. Please go ahead.
Sir, you've been sharing with us that the EBITDA margin will lead the volume growth. We can say the EBITDA in absolute term will grow much more than the volumes. And on the other side, you're sharing with us that you will sacrifice the pricing for the volume growth. So aren't these two statements contradictory?
We didn't say any of those things.
I'll tell you, what we said was volume growth is the priority. And then if the market affords us, it tells us clearly that there's a volume growth possible with the judicious pricing approach, we'll do that because that is what is important. If the market tells us that there is no possibility of a volume growth, then it's our job to ensure that we get the right pricing. So that's how we have to manage. But finally we said that we need to grow our volumes ahead of the market, grow our EBITDA ahead of the volume growth, and the PAT ahead of the EBITDA growth. That's what we said.
So if we were to take a scenario where the volume does not grow hypothetically in FY24, right, then your EBITDA in FY24 will be lower than FY23 because volume is the priority and not the pricing.
So I did tell you that finally the EBITDA per metric is a derivative of how the macroeconomic situation is and how we ensure that we are able to grow our volumes. What we are clearly telling, because we do not know what the situation in terms of demand is going to be 6-9 months from now. If it is going to grow by 10%, we better ensure that we grow at 10% minimum. Correct? If that requires us to do judicious price corrections, we need to do that.
So if there are challenges on the volume growth, and if we do not get the benefit of export from Egypt like we've got this time, and if volume is the leading focus for us, our EBITDA in FY24 could be substantially lower than what it is in this quarter.
Not necessary.
You very well know how EBITDA gets arrived at, right? Revenue minus cost, right? Minus various costs.
So how do you manage your cost judiciously? How do you manage your RM person judiciously? How do you manage your pricing appropriately? Sum total of all that is out is the EBITDA per metric ton.
Right.
So various levers available, correct? So we need to use the appropriate levers to be able to deliver profitable growth.
Okay. Thank you so much.
Thank you.
Thank you.
Thank you. Next question comes from the line of Divyata Dalal from Trident Capital Investment. Please go ahead.
Hi, good afternoon, sir. Thank you for taking my question. I wanted to understand a little bit more on the statement that you made that in terms of performance surfactants, we are able to manage better realization because of the product mix. So one, I would like to understand which are the geographies where, we are able to get a better product mix. And second, are these trends sustainable?
First question we cannot answer with geographies.
Okay.
That's very clear. Okay. Second question, we want the environment to enable us to sustain that. Okay, but as I said earlier, okay, we're not going to be, if it requires that we need to price it appropriately to gain volumes, if the market allows us an opportunity, we'll do that. So that will be the answer, but we can't make any such specific statement on that right now.
Okay, no, my question was more pertaining to, since we've seen that the India market is also growing well. So are you seeing a structural change where, the mass, in the product mix where the mass or lower realization products are, lesser as compared to people moving towards premium products like
kindly note that the products that we talk about is always what has happened. We are only telling you what has happened. But our effort is always to grow in all categories, in all segments. Okay? Now what has happened is that in the last year, because of the highly inflationary pressures, okay, the market, let us say, chooses certain product categories vis-a-vis some other product categories. This can of course change once normalization happens. Okay, and our job is to respond to this market and respond to these opportunities.
Okay, so we mean to say that this is not a normal situation, and probably once normalization happens,
see. Kindly note that we don't design our business on the basis of EBITDA per metric ton.
Right.
EBITDA per metric ton is always a derivative.
No, I completely understand that. My question was just to understand the trends in the market, whether in performance surfactants, whether the demand is such that it is moving towards more premiumization product as compared to a mass product. I just wanted to understand the trend in the market.
Nothing such trend is visible.
So, see, what is important to understand is that all markets are a combination of mass, prestige, and prestige. What we mean by premium, okay? Now, particularly in the last year, there was a significant impact with respect to the prestige products, which in a way reflected in the decline of specialty products as far as last year is concerned. Okay. Now, again, as far as these markets which have had a impact because of inflation in terms of the volume, our customers very obviously rejig their particular portfolio to ensure that they respond to the ultimate consumer's requirement and demand and need. Okay, they accordingly calibrate their own offerings. To give one example, you would have seen some of our multinational customers saying that customers in the last year preferred a lot of smaller packs. They prefer to buy a lot of smaller packs because of the inflationary situation. In which case, the entire mix of offering that they offer differs from previous. However, they may play a different tune when the situation comes back to normal. Okay, so these are the sort of changes which happen in the market, and our job is to fundamentally respond to these changes with agility and with ensuring that we are able to meet our service requirements of our customers very, very promptly and properly.
Got it, sir. Got it. All right. And one bookkeeping question on the CapEx. What is the CapEx that we've planned for FY24, and what CapEx have we done till 9 months FY23?
As you said, we have always indicated that our capex per year approximately will be 150 crores, it would be there even for the next maybe 2 to 3 years or so.
This year we have already crossed about 120 crores in these 9 months.
Yeah, we have already crossed 120 crores in the 9 months.
Okay, fine. All right. That's it from my side. Thank you and all the best, sir.
Yeah.
Thank you. Thank you. The next question comes from the line of Dinesh Pathak from Yato Asset Management. Please go ahead.
Sorry, this is Dinesh Pathak from White Asset Management. Sir, what is your market share in the covered categories and the geographies? Maybe you can take one by one, like India.
We would not be talking about these numbers.
We don't talk about market
We don't talk
shares.
about these numbers.
Yeah.
No, so what I want to understand is that you said that we will grow volume ahead of the market, but market, from my understanding, there would be various markets where you're not present in. Are you nurturing new markets? Can you talk a little bit about that?
No, in the various we are already present in about 76 to 80 countries. What we are saying is that in terms of the products that we operate in those particular countries or geographies, and with respect to those particular products, we grow ahead of the market. Yeah.
Okay. When you said Turkey is 10% of the revenue, this is total revenue or just AMET revenue?
Total revenue.
Total revenue. Okay.
Yeah.
Sir, this L'Oreal alcohol would be what percentage of your raw material buying?
It's about 60% of our raw material buying.
Okay. This is important only for performance, and in specialty there is not much L'Oreal alcohol, right?
Yeah, there will be not much of L'Oreal alcohol in performance in specialty products.
Yeah.
Okay. How much of the tonnage is exported from India? And how do you account for the freight? You book it both in revenue as well as in other expenses freight?
We didn't understand. What is the question?
So, how much of the tonnage that you sell every year is exported from India, and also let's say exported from the plant that you have in Egypt? And
the international sales constitute approximately 2/3 of our total sales. Okay. So as far as India is concerned, export 50-50 approximately 50-50.
So what you produce in India, 50 you consume in India, sell in India, and 50 you sell abroad, right? Like that.
Yeah.
Okay. For the 50 that you sell abroad, export, you like raw material, I have an understanding of your pass-throughs with some of the clients. For freight, if you can explain this 50% of which is exported from India, how is freight accounted for, and is it passed through? What is the exposure to freight volatility?
It's not as simple as that, because finally freight was still last year the way it went up was a very small component of the overall pricing. So typically freight moves with there are some places where we do a 3-month freight contracts for customers. We have some places where we do a 6-month contract. So it's not one size fits all sort of a situation. So the objective is to ensure that we take the right service, deliver volumes, customer schedules very well on time, and then ensure that we buy at the right price, the freight. That's how it is worked out. So there is nothing where we try to manage our freight positions in a very different way.
Okay. What would be our capacity utilization, sir?
Approximately 66, 67.
67. It can go up to maximum of what?
We normally, when it almost nears 80 to 85, we start thinking about increasing the capacity further.
So the capex that you're doing 150 crore a year, this is just maintenance capex? There is no growth?
No, it's a
combination of maintenance plus growth.
Okay. How much capacity are you adding? If you can just talk about that as well.
That's a combination of what we do in both performance and specialty. So we typically would not be able to comment on that.
Okay. Okay. Thank you, sir.
Thank you so much.
Thank you.
Thank you. Due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you. Thank you very much. Thank you, ladies and gentlemen. Thank you for your presence. Have a good day and see you in the next quarter.
Thank you all.
Thank you. On behalf of Galaxy Surfactants Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.